There is a long list of big investment questions that face Canadians on a daily basis. Is relying on the sale of your primary residence a responsible way to plan for retirement? Is actively managing your investments or having someone do it for you better than simply investing in an index fund? And what is the right level of risk you should assume when investing for your future? Joining me now to unpack some of these big questions is Brendan Caldwell, Director at Caldwell Securities Limited. Brendan, thank you for joining us today.
Always great to talk to you, Julie.
Brendan, we know a lot of Canadians are banking on the sale of their primary residence to help fund their retirement. Is this a good strategy?
On its own, no. That's the straight answer. Now, I disagree violently with our Prime Minister, who said recently just didn't understand how people think they can just put money into their houses and that's going to take care of their retirement. He doesn't understand it because he's never had to do it. But for most people, yes, most of their wealth is tied up in their house. And the concern that I have is that there is no pool of wealth that governments at all levels don't want to get their claws into because they need money so desperately. We took a full-page ad out in the paper a couple years back, imploring the federal government not to tax the capital gains on primary residences. I think after the brouhaha with the other capital gains taxes that they're thinking of putting in, I'm not sure that at least this present government will go any further with that. So it's a bonus. Having your wealth in your primary residence is a bonus. It's not the only thing, though, because the idea that you're going to retire off your primary residence, well, where are you going to retire to? You're going to pay rent somewhere? You're going to live in a smaller house? You're going to downsize? That may or may not work for you, but I think people need to be saving separately and independently from just having money tied up in their house.
And can you break down for us the debate over active and passive investing? How do we best determine the most effective path?
I'm not sure exactly how you mean it. Your intro was a little different than what your question is, in that active investing is where someone is actively making the decisions to buy or sell. Passively investing is where you're just buying the index, buying the market. And both are good strategies. I do think that the vast majority of people should have someone that they're talking to about their investments, whether they buy an index or an actively managed mutual fund or individual stocks, or put 90% of their money in a GIC and have 10% in venture capital. However you space it out, I think having someone to bounce your ideas off of for the vast majority of people, and including we have some highly sophisticated investors here that you think more than most do it on their own, whatever that means. But having someone to talk to at least makes you say out loud your idea to another human being, and in so doing clarify your own thoughts. And actually the act of putting it into words in a way that somebody else can understand helps a person understand it better. So that's all your advisor does, is be a good listening board, a good sounding board. Then that's been very helpful to a lot of people.
And how much risk should someone take on when investing? And does that vary depending on their age or the purpose of their investment?
It's just a question, Julie, of what kind of risk. Everybody's got risks. The risks of living too long, risks of running out of money before you run out of breath. Those are all risks. The question is how to mitigate and manage those risks. For most people, most of the time, regardless of their age, they should probably have most of their money in investments that can grow. I'm not even advocating for this or that particular investment, but the investments have the capability of participating in the ideas, the wealth creation, the economic gain from the society at large, which is different than investments that are guaranteed. Investments that are guaranteed right now pay 4.5%, and that may or may not be enough money for people to not outlive their resources. But I think most people should have money in something that can grow at least some percentage regardless of their age.
And quickly, what about investing apps? You've raised some concerns about those apps in the past. Tell us quickly about your objections.
Well, they have tried to make investing apps, particularly the discount brokerage apps, not picking on anyone in particular, but make them more attractive, more gamified, more bells and whistles to make it more fun for people to trade, as though this were Tetris or some other video game. I think that, again, most people benefit from putting things into words, and just clicking things on your apps are not going to be the way that most people are able to accumulate serious wealth.
As always, thank you so much for your time today, Brandon.
Thank you, Julie.